Okay, welcome everyone to Black Man Speak. I'm your co-host, the JR Stewart.
And I'm your co-host, the Tommy D, Duncan the third, otherwise TD3. Jimmy, it is Wednesday night, December the 21st, 2022. Jimmy, 2 weeks left in December, and if it's Wednesday night,
It's Black Man Speak. So let's give a big shout out to Liquid for providing our theme music. And if you haven't already, please hit that like button so we can get our numbers up. Spread the word, and then subscribe to our channel, be it on YouTube or Facebook or Twitch. Where else are we beaming, Tommy? Did I catch everyone on Twitter? Oh, and Twitter. So
yes.
I think those are the 5 platforms that we're streaming to. And I also want to say thank you for all the well-wishers. As some of you know, I've been sick the last couple of months. I'm just starting to recover and feel better. But I want to let you know. Okay.
All right, it looks like I fell off there, Jimmy, but I am back. Sorry about that.
Okay. I was wondering where everyone went. So with that being said, Tom, let's get this show on the road.
All right, folks, it is the end of the year, 2 weeks left. It is the Wednesday before the weekend of Christmas. Everybody is thinking about whatever their Christmas fare is, whether that's turkey and dressing and all the trimmings, Jimmy, or whatever that happens to look like. But the other thing that we have to start thinking about within the next month, tax time.
Tax time.
So we have a very special guest who I've known for a very long time, who we are bringing to our show and to our views today to talk about year-end tax moves and strategies that actually could help your wallet. So we'd like to welcome John R. Williams, Jr., CPA extraordinaire, a gentleman I've been knowing for probably more than I want to admit or that he wants me to admit either. But we're going to talk about things you can do before the end of this year that might help you with your taxes. John, welcome, welcome, welcome.
Gentlemen, it's a pleasure to be on the show tonight with you all. I've had an opportunity to tune in a couple of times before, and I'm very impressed with the show and your guests. So it's a pleasure to be here this evening.
Let me say this, John. Tommy, let's make sure we post John's information on the screen. And I'm going to advise everyone before you do your taxes and you listen to your neighbor telling you how to file for a credit and wind up like Wesley Snipes, call John, seek advice from a professional before you do something crazy. Make sure that, because there's a couple 100,000 lines in the tax code. So you need someone who's professional who understands that much code.
Yeah, this is very important, folks, because this stuff will follow you the rest of your life, and you don't want to make any mistakes. So we're going to have the conversation tonight. And there are a lot of things, John, that I was thinking about, even beyond what we were talking about a day or two ago as far as what we wanted to address with the show, because we have different folks in different stages of life.
Absolutely.
We have young folks coming out of school or just starting their career, starting families. We got folks who are senior citizens or people who are caring for loved ones who are senior citizens, possibly retired, folks who are in transition with children, with college. And all of those might mean different things when it comes to tax strategy and what they should be doing. So let's start out with some basic conversations. We'll see who joins us tonight via the chat and or via a call-in number, which we'll make available to you, and see where this conversation goes. So let me fall on my sword. John, taxes are probably one of the most stressful times of the year for most people, and most people sometimes avoid taxes like the plague. Tell us about yourself, how you got into the tax business, being a CPA, and then we'll go from there with our questions.
Okay. Well, I've been a CPA since 1995. Shortly after college, I actually worked for a couple of companies in their accounting departments. And I decided in 2002 to open my own firm, which I focused primarily on tax. I still have about 15% of my work is consulting, but the bulk of what I do is either going to be tax or tax compliance. So I just feel like when it comes to taxes, in terms of professional, you need someone who's dedicated to one area versus trying to cover a lot of different aspects of accounting.
I appreciate the background. Tell us a little bit about your clientele, your portfolio of customers. What do they look like? In terms
they're
of graphics, backgrounds, everything.
Yeah, they're an array of clients, but I would say the biggest focus or the centralization of the clients are primarily either business owners or clients who still are W-2 employees, but also have a business. Either the husband or wife has a business. And so most of my clients, not all of them, I would say still somewhere in the area of 35% to 40% of my clients are individuals. They don't have any business interests outside of that, but somewhere around 60%, they're either going to have a business or some type of real estate, something other than just a W-2. And so with that being said, when you have a business or you have sources of income other than the W-2, you normally have more opportunity to take tax deductions and tax breaks if compared to someone who essentially derives all their income from W-2 income.
Okay, so entrepreneurs, business owners, folks with multiple streams of income.
Yes. Mm-hmm.
How does one determine whether it's worthwhile, if this is an appropriate question, whether they should take a standard deduction or whether they should actually itemize on their taxes?
Well, the standard deduction is set by the IRS. For 2022, the standard deduction, if you're single, is $12,250. And so the process that the taxpayer would go through, or I would go through when I'm preparing the taxes, is basically I'll send out a tax checklist or a tax organizer to all of my returning clients every year. So I normally try to get that out normally by the first or second week of January. And so one of the items in that tax organizer, or some of the items in that organizer, would be I would request your charitable contributions, the property taxes that you paid for your residence, and the mortgage interest. Those are the three biggest components of itemized deductions. When we're talking to some senior citizens or individuals who have health considerations, you would also throw medical expenses in there. But for the bulk of Americans, state and local taxes, mortgage interest, and charitable deductions are going to make up the bulk of itemized deductions. So once I have the taxpayers' information, I would basically add up all of their itemized deductions. And if their itemized deductions are greater than the standard deduction, then that's the route to go. Because the taxpayer is going to receive a bigger benefit from itemized as opposed to taking just the flat standard deduction. And another thing to note is one of the big changes that occurred with standard deductions with the tax changes that were implemented in January of 2018 is that the state and local tax deduction or write-off is limited to $10,000. So with that limitation, sometimes I see clients now, they're not able to they're not able to capture the full benefit of their itemized deduction. So hopefully there's some talk in Congress that they may change the law back to what it used to be, because that really impacted a lot of taxpayers. Because essentially, if you live in a state that has a state income tax, it doesn't take long for the state income tax and the state property tax to add up to 10,000, and anything above that number, you lose the deduction for that year.
That kind of sucks.
Yeah, it does.
Yes, it
To
does.
say it mildly. So hopefully they will change the law back to the old law, because it really impacts middle class taxpayers, and they take a punch in the stomach because of that SALT limitation.
So, John, maybe you could speak to this, or maybe you're too busy working. But it seemed like every year around tax time, you get so much disinformation on these various tax deductions that you can take. People claiming that you can file for this and write off that. Which is why I say it's important to go to a professional who knows what they're doing. Can you speak to some of the disinformation or misconceptions that people have out there on things they can file for and that really aren't true?
Well, a lot of times what I hear is I'll hear someone mention that or ask me, hey, I heard I could take a deduction for X. And normally my answer is yes, that is correct. But so let me give you an example. Almost at least once every couple of months, I'll have a client call me and say, hey, I'm looking at buying an SUV that weighs over 6,000 pounds, and I heard that you could write that all off in 1 year. And under the current tax law, that is correct. But that if you own a business. So, but the catch to that is you have to actually use that asset, that vehicle in your business 100% of the time to be able to take the write-off. So a lot of the information I hear is accurate information up to a point, but like I said, it's always normally a but that you have to take into consideration for the information to be 100% accurate. So,
John, did you say 100% of the time as we use for the business?
yeah. So going back to the vehicle, if you use a vehicle in the business, you can deduct it. So it just depends on the deduction is dependent on how much you use the vehicle in the business. So whether you are taking the standard mileage rate or the actual expense rate, those are the two methods of expensing a vehicle when you use it in a business. You have to look at the percentage that you actually use the vehicle within the business to be able to take the deduction.
So the things get muddy when you're using it for personal use and for business?
Um, Well, if you could keep good records, that helps to to distinguish between the business portion, business write-off versus personal. So the best thing to do is to invest in a mileage app, or
Mhm.
a lot of people even keep a written log. But there are quite a few apps that you can download and use them to track your business miles. And then at the end of the year, when you come to see me or your tax professional, all you have to do is download that app and send it over to us with the rest of your tax information, and we can determine your business use versus personal use percentage.
Got it.
Good deal. So let me ask you this before we delve into some of the other questions. We're about a quarter of the way through the show right now. What would you consider as a tax professional the most misunderstood or overlooked or maybe misconception about taxes, filing taxes, the whole beast?
Well, I would say probably the big misconception is that it is impossible to deal with the IRS. Um, currently, currently that's probably true because they're extremely understaffed and they're very behind. So, if you've been following the news, Congress recently approved, increase in the IRS's budget, which could be good for some people and could be bad for other people, depending on if you're a tax dodger. But the reason I bring that up is that the misconception can lead to a taxpayer owing more money or being in trouble with the IRS, because what I see sometimes with new clients, not my existing clients, because my existing clients, if they receive a letter from the IRS, they don't really worry about it. They just send it to me and say, hey, you deal with it. But for the new clients, a lot of times I'll see a situation where they've just ignored the IRS. And so they, for some reason, whether they've been intimidated or they just don't want to deal with it, if you ignore the IRS, that's not a good thing. Even if you owe a lot of money or think you owe a lot of money, if you're proactive and either reach out uh, to a professional or reach out to the IRS yourself and get the wheels turning, the IRS is, I wouldn't say that they're ever going to be your best friend, but they are a lot more willing to work with taxpayers that are taking an initiative to address whatever questions that they have, as opposed to just taking a letter, the notice from the IRS, and putting it in file 13.
So
So
otherwise, ignoring it ain't gonna make it go away.
no, it won't make it go away. And normally it actually gets worse. And sometimes, because the IRS is so behind, uh, taxpayers may receive a notice in the mail and it's totally inaccurate. And so, because um, you know because the taxpayer may not be uh, familiar with the language that's used in a letter, or if they don't have a professional that they can call and work with, uh, they tend to delay the issue. But there's been many instances where, and I'll give you an example, where even this year, because the IRS has been so far behind, I've filed tax returns for clients and notified them of the balances that was due, and they paid the balance instantly. But 3 or 4 months down the road, they would receive a letter from the IRS saying, hey, you need to pay this balance. And I'd say, hey, just, you know, don't worry, you mail the money in, they'll eventually get it cleared up. So in that situation, if you open a letter, if the taxpayer opens a letter and they panic, they could end up paying the tax bill twice, and it takes an extremely long amount of time to recoup any overpayments from the IRS. If it's, if the paperwork is filed manually, if everything's done electronically, the process goes a lot smoother.
So the moral to the message is call you first.
Yes.
Okay, we got it.
Unless you're 1000% sure that you're comfortable doing the tax. And like I said, even even if you feel comfortable, doing your taxes, you never know. There may be one tax break, one deduction that you overlooked that would outweigh or the amount that you would need to pay me to prepare your taxes. So it's always good to reach out to a professional and at least get an opinion from the professional as to whether or not they should seek you should seek his or her services. So I'm normally not going to turn anyone away, but if there's someone's taxes that are just so simple, I'd say, hey, you can do this in 10 minutes. You don't need to use me.
So you got your HR blocks of the world, and then you got John Williams. What is the difference between tax preparation and tax planning when you start looking at your overall tax strategy?
Well, and here's not to knock H&R or Jackson here. They have good franchises.
Yeah.
What I would say more about my business and the services that I can provide is that you're always dealing with the same professional, year after year. So if you go to a storefront tax prep service, number one, they're not CPAs normally, unless you go to. They have different levels of that serve clientele based on their needs. So one of the important, I believe, one of the important aspects of maximizing tax deductions or maximizing your tax return every year is to be able to work with a person who understands your tax history. So one of the steps that I go through before, whether it's a business client or a personal client, is before I wrap up a tax return, I'll compare the results to prior year results. And a lot of times I'll find that the taxpayer, just they forgot to give me a certain form or make me aware of a certain expenditure that they had if it's tax deductible. And so by using the same professional, obviously you want to use a qualified professional, but by using someone who has a history of your tax situation, many times the professional is able to see something that doesn't fall into the trend. And for example, I have taxpayers in the past where they refinanced their homes, and so when I'm looking at their itemized deductions and their interest is 40% lower than what it was the previous year, I'm able to say, hey, something doesn't look right here. Did you do a refinance or did you forget to send me one of the mortgage 1098s? And so sometimes, taxpayers aren't, they're, you guys are engineers or doctors and nurses. So, you focus on what you focus on. And a lot of times with everyone has a demanding careers. So it's just it's good to be able to turn everything over, hand everything over to your CPA or tax professional at the end of the year, and that way, you know for sure you're going to get all your deductions.
What's the difference for those laypersons who don't do this all the time? The difference between tax deductions tax credits and how that makes a difference in terms of your overall adjusted income?
Well, a tax deduction essentially reduces the amount that's going to eventually flow to the taxable income line on the tax return. And so the benefit of a tax deduction is basically if you have a $10,000 tax deduction and you are in the 24% tax bracket, that deduction will generate a benefit of $2,400. Whereas a tax credit is, if you had a tax credit for $10,000, it's a dollar for dollar reduction in the amount of taxes that you owe, or in the amount of taxes that you refund that you're going to receive back. So a tax credit is much more, it packs much more power than a tax deduction.
What are examples of tax credits?
A tax credit would be an earned income credit, the educational credit. So
what would be examples of those when you say an earned income credit or education credit?
Well, earned income credit is normally for, well, it is not always, it is not normally, it's for taxpayers with lower income. And so mostly it is going to be for the single taxpayers with children or who benefit the most. So if your earned income is below a certain level, you qualify for a credit. And I don't have a lot of, my clientele, a lot of them they don't really fall in a category, but, every now and then I do have a few clients that are younger clients that take advantage of that. So, so the credit, and you also, you have to distinguish between refundable credits and credits that are not refundable. So the earned income credit is a refundable credit. So that means that even if you don't owe any taxes, you still get money back. Whereas some other credits, basically that credit will reduce the amount of tax you owe dollar for dollar equal to the credit. But once you get down to zero, a refundable credit doesn't allow, once your tax liability gets down to zero, you're not able to get a refund for that credit. So the credit is basically a dollar for dollar reduction in your tax liability. And one thing that a few minutes ago you were asking me about misconceptions, Tommy. And one of the misconceptions is about tax deductions, because sometimes I'll hear people say, well, they can afford to give so much to charity because they get it all back when they do their taxes. And that's not true. Number one, you have to be able to itemize, as we said earlier, to be able to take a charitable donation. But also the charitable donation is a deduction. And so the part of that you get back is whatever tax bracket that you fall into. So if you give $10,000 and you're in the 10% tax bracket, you only get 10% of that. You don't get all the $10,000 back.
So deduction.
And so that's the big thing about a deduction versus a credit. Some taxpayers are under a conception that if they have a tax deduction, they'll get all of that back, and that's not true.
And so the earned income credit. Go ahead, Jimmy.
I was going to ask him, do you see very much tax credits for like EVs, electric vehicles, or solar panels?
Yeah, I had a client, well, last year and the year before, different clients. They took the EV credit. Now the EV credit changes a little bit after 2022, after well, in another week or so. So under the inflation, well, currently you're able to take up to $7,500 credit for electric vehicles, but the terminology has changed a little bit starting in January of 2022. And these were changes that were implemented under the Inflation Reduction Act. And so now you can take a credit on a new vehicle of, I believe it's 7,500 and 4,000 for a used vehicle. And it doesn't have to be specifically an EV. It's I believe the terminology is a clean vehicle credit. So that's Jimmy, that's one of the biggest changes that came about, or one of the big changes in the Inflation Reduction Act in terms of actual individual taxpayers. So that goes into effect in January. One of the downsides to that change is starting in 2023, there will be some limitations on the credit based on taxable income and the size of the battery that goes in the EV. So, but the credit is still out there.
Gotcha. Good deal. So earned income credits, usually you're talking about lower income and or young people because they don't have high incomes in terms of benefiting you during tax time, correct?
Yes, yes.
So that's really not something that mid, upper middle class or wealthy people deal with when we talk about earned income.
No, and even working class individuals, if you're looking at a two earner household, normally you're going to go above the limits, and the limits change a little bit. They're adjusted for inflation every year, but normally a two earner household, you're going to go outside of those limits. So it's really for more taxpayers at the lower end of the income spectrum.
How about non-citizens, John? How about people who are not U.S. citizens who file an income tax return and claim their earned income credit because they have children?
Well, they are you asking me, can you do that?
Yes.
Yeah, as long as you're a taxpayer. So if you're required to file and pay income taxes, I have to look at all situations, but just off the top of my head, I would say yes. If you file
Well,
an
I
income
suppose
tax,
extremely poor who has no income or very little, but still files a tax return.
well, you do have to have earned income. So that's one of the stipulations. So you do have to have earned income to be able to take advantage of the credit. And that on a very low end, you also do not have to. Most people that benefit from the credit have dependents, but
Mm-hmm.
their individuals can take advantage of the credit, but it's at a very, very low income level.
Sure. Okay.
So you have somebody, John, who is a W-2 employee, does not have side business, second job, whatever it is. When the tax laws really start working for them in terms of being able to say, okay, it's time to start itemizing. Actually, this is working in my favor to itemize, and I can get more value, more bang for the buck. Is it because they're at a certain income level? When does it make sense for them, and when do they start getting more benefit from the tax code?
Well, the itemized deductions are basically they're just a math, a math formula. So either you have enough or you don't have enough. But
And that enough is what again?
well, your standard deduction, let's say if you're single for 2022, is 12,950. So anything if you take all your itemized deductions and they add up more than then
13,900.
12,950 you're able to itemize. So that's
It
pretty
doesn't
easy.
matter what. It doesn't matter what tax bracket or how much money you make.
Well, it varies. So let's say if you're, if you're married filing jointly, take that number times 2.
Okay, so that would
And
be
then if
almost 26,000.
and then if you're filing head of household, see if I have the head of household number in front of me. So it changes depending on your. So 19,400 for 2022, that would be the itemized. I mean the standard deduction for someone filing head of household, meaning you're the only person on a tax return and you have dependents. So
So we add
that,
up all those. We add up all those charitable donations, state, local taxes. If you're in a state like that, mortgage tax and interest. If that's at least.
it needs to be at least equal to your standard deduction. I mean, it needs to be greater than your standard deduction.
Okay, gotcha.
To be able
You brought up something else though. Single versus married. Does the tax code work in the favor of someone more who is single, married, or is it neutral? It just
it's really it really has moved more to neutral in recent years.
They used to incentivize family and marriage. What happened?
I remember that.
Yeah, because let's say that going back to, not to pound the standard deduction, but go back to that. So if you're married, you get 2x, 2 times the 12,950. And so in many cases, what I see, since the law has been changed and the standard deduction was increased, many times it's more advantageous for clients, especially clients who don't have large mortgages, to just basically use the standard deduction. And so when you, going back to a few minutes ago, when you asked me whether or not it's beneficial to reach out to a professional, I would say in the situations where a taxpayer, if they're only a W-2, I'm not, I don't mean to say it that way, but if their income is coming primarily from a W-2 and they don't have a business and they don't have enough itemized deductions, in other words, the standard deduction is greater, that's really the ideal taxpayer that really qualifies, or I would feel comfortable saying, hey, more than likely, if you do your taxes and I do the taxes, you're gonna end up coming up with the same result as what I would, because there's not a lot of moving parts on the tax return. You basically have your W-2, and depending on whether or not you have children, obviously if you have dependents and if they're under a certain age, that can add some complexity to the tax return. But if I had a taxpayer that didn't have small children and their only source of income are W-2s and they don't itemize, that's really the person that I would say I would feel most comfortable. If they ask me whether or not they should use my services or not, I'd probably say, you're more than likely you're going to get the same outcome that I'm going to get.
How about the more children people have? Hurt?
Well, the more children, especially not so much this year, but especially last year with the advanced child tax credit, that was a tough year for a lot of CPAs, because I had a number of my clients, and I said, hey, send me, because when the IRS passed when Congress passed the law to where taxpayers could take advantage of the advanced child tax credit, essentially, you were receiving the credit during the year as opposed to, when your taxes were prepared. But at the end of the year, the IRS gives and the IRS takes. So whatever they sent out at the end during the course of the year, we had to report that on the tax return. And so there were just numerous situations where the client, like I said, they're not accountants. And so they weren't able to keep track of all the payments, the monthly payments that the IRS was sending out. And so I made sure to quiz them, at least 3 times if they didn't give me any amounts for child tax credits. And of course, there's always going to be a couple of people who forget. And so, about 3 months after I prepare the tax return, they get a letter and say, hey, we sent you X amount of advanced child tax credits, but you don't show any advanced child tax credits on the tax return. So that's the situation that you have with children. But so to answer your question, Tommy, if you have small children, or even if you have children that are in college that qualify for educational credits, more than likely you're gonna benefit by using my services. And not only qualify for educational credits, but also if a taxpayer has a child that they are funding their education with a 529 plan, the withdrawals from a 529 are not taxable, but they still have to be reported on the tax return. So, if not, the IRS will, send you a reminder after the tax return is done that something is amiss.
Yeah, I had a friend, John, about 40 years ago, has a small business. He was making pretty good money as a single person, but he wasn't happy with when he had to pay taxes every year. And I think his CPA told him to the only hope he had was to get married, buy a house, and have children, not necessarily in that order. But he got all 3 of them done that year. Um, so I didn't know if it was love that drove him to the altar, or it was a tax man that drove him to the altar.
Well, I would have to agree. That's a good, those are good recommendations. The only thing I would add to that is you try to stay married, because if you don't stay married, divorce could have a larger
Yes, he is
impact
still
on
married to this day.
Okay, you have to unpack that, James, John. If you get divorced, how is that going to impact your taxes?
Oh boy.
You might have single status, man.
This is real talk.
Hopefully the divorce is amicable, like Tom and Giselle. But if it's not, there are an array of issues that could come up.
For instance,
well, let's say that the taxpayers have been filing jointly, which most married people do. Not all married people. There are some situations where, even though it's not financially smart to file separately because of some extenuation circumstances, the taxpayers have to file separately. But so let's say that in a situation where a couple splits, and let's say that the last year that they're together, either the husband or the wife, they have a lot of income, or some type of income that has not been reported to the IRS. And if they file jointly, the tax return goes through, and let's say a year down the road, they get divorced. And so sometimes, it may take a couple of years before the IRS, figures this out. Normally it's less than that, but it could take a couple of years before, they determine that there's been an underreporting of income, or the income could have been, let's say if it's a business, the income could have been reported correctly, but let's say the taxpayer was too aggressive with the tax deductions, the business deductions that they took. And so if they, even though they're divorced, if there is an issue with the tax return, both the husband and wife, would be held responsible for making the liability whole with the
Even though they're
IRS.
divorced. Even though they're
Yeah,
divorced.
yes, as long as when you file a joint tax return, um, unless there's a situation where you file innocent spouse, you're, jointly responsible for the taxes that are due and the information that's on that tax return.
So if something got messed up in 2021, y'all got a divorce in 2022, then both are still responsible regardless of who messed
Yeah,
up.
both better go back and fix it. So that's it. Hey, John, before we run out of time, uh, can you speak a little bit about audits and your part in it if a person is audited by the IRS? I don't know if there's anything more frightful than that, other than some felony arrest warrant being issued for you.
Yeah. Well, let me distinguish between an a audit and a notice. So my clients, for one reason or another, clients are going to receive notices from the IRS, and let's say that going back to the income again, let's say that a client, when they give me their tax organizer and it's a business client and they give me all of their income and deductions, but they leave off a 1099. So if that 1099 is not reported on the income tax return, the IRS is going to, notify us of that. Or it could be an array of issues, small and large. So when taxpayers receive a notice in the mail, that's not an audit. But I have clients call me and say, hey, I'm being audited. I said, no, you're not being audited. And a lot of times the IRS may just need another form. So let's say if I'll give you a good example. I had a taxpayer that thought he owed $200,000, and the problem was he sold a house and he forgot to tell me. He sold his personal residence and he forgot to tell me about it. So even though the sale of a personal residence, even though if you're single you get to exclude 250,000 of the gain. If you're married, you get to exclude $500,000 of the gain. He didn't have a tax liability, but you still have to report the sale of the house on the tax return, because
Okay.
when you go sell your house and you leave the title company is going to give you your stack of papers, but they're also going to send what's called a 1099-S to the IRS, indicating that a property has been sold. So that's a good situation where basically all I needed to do is write a letter and send the information, all the information that the IRS needed to show where he sold the personal residence, and the whole issue was fixed. So when you receive a letter, don't automatically assume that it's an audit. But an audit occurs when a tax return has been filed, and the IRS, they don't like something that's on the tax return, and so that's when they will either ask for additional information and they'll do the audit at their office, or if something is really, really out of order, um, they will ask to do a field audit. And that's when they actually come to the client's office or, place of business, and they look at the records. So that's something that you don't want. I don't believe I've ever had one of my clients have a field audit. Normally, a field audit will involve payroll tax, and
Okay.
uh, the IRS will work with you on a lot of things. They're forgiving on a lot of with a lot of mistakes, but the IRS really has a zero tolerance policy when it comes to payroll tax, because their view is that if you are a business or an employer that has employees, if you withhold payroll tax and then you don't send the payroll tax to the IRS and the Texas Workforce Commission, they look at that as if you have stolen funds from the IRS, and they have a
Oh,
very
yeah.
yeah. So, and yeah, that's true. And so, in terms of audits, I think I'd have to go back for a while. I think I picked up a client, and when I picked them up, they were in the middle of wrapping an audit, but it had to payroll tax.
Yeah, just don't dip your hand into that pile. Just pay that money and
No, no, it's I normally recommend third-party processors like ADP and Paychex. There's only two of my clients that I do payroll tax for, because no, the third-party processors do a great job, and it's just, that's not my area of focus anymore. So you don't ever you always want to remit the payroll tax to the IRS.
All right, John, we have about 10 minutes or a little bit less, so we're going to have to make it real snappy on these next couple of questions.
Okay.
Well, we've had, obviously, a lot of activity with Fed policy this year, interest rate changes, et cetera. We've obviously had a very volatile stock market over the past year, and then the real estate markets have been crazy over the last couple of years. Any opportunities out there that you see from a tax perspective this year? Because it's been a very interesting year as we have 2 weeks left, or a little bit less than 2 weeks left, in terms of making some moves towards at the very end of the year that could benefit them.
Well, normally the moves that can be made are going to be with taxpayers that own businesses. So going back, and I don't encourage any business owner to make up or spend money on business expenses that are not necessary. But there was one of my clients did call me up a couple of weeks ago, and they were looking at buying some heavy equipment. They're in the commercial real estate business, and there were some, pretty, big equipment purchases that they needed to make. So, and not to get too deep in the weeds, but we were talking about depreciation a little bit earlier. So, one way of writing off business equipment is expensing, which is bonus depreciation and Section 179 depreciation or expensing. And so one of the changes that came about in 2018 is that the tax law currently allows taxpayers to write off 100% of the equipment in 1 year.
That's pretty good.
Wow.
And so now, bear in mind that if it's a business asset, you can eventually write it off if you hold it long enough. But depending on what type of asset it is, it could be, the depreciation may run over 5 years or 7 years, or if it's residential property, residential real estate, it could be 29 and a half years. So but the reason I mentioned that is that the tax law is going to change in 2023. You'll still be able to write off depreciate business assets, but that bonus depreciation drops from 100% down to 80%, and it trails off. So it goes 80% next year, 60% the year after that, and eventually it goes down to zero. So that's one of the items that I would say is, for business owners, if there are expenses that are deductions that you believe that would help your business, and sometimes it's going to be crucial that you take them in the current tax year if the law is changing, and you really don't know unless you reach out to a professional. So That's why it's good to work for a professional, because if you give me a call and I can tell you whether or not the tax law is going to change and whether or not you need to move in the current tax year or the next tax year. One of the benefits for individuals under next year, the tax brackets will be expanded some due to
What does that mean?
inflation. Due to inflation, so that you will remain in a lower tax bracket longer than you starting in January than you would have been in this year. So basically, Congress and IRS adjusted the tax table to where the tax brackets are a little bit more expansive because of inflation. And so that's one of the benefits that individual taxpayers will be able to take advantage of next year without really doing anything.
Okay.
Nice. And in terms of keeping up with the tax code, I mean, that's very expansive beyond the scope of what any individual is going to want to do. But if they want to keep up and educate themselves, what resources are available so when they talk to a tax professional, whether it's yourself or whomever their tax preparer is, they can come to you informed and armed so that you can have better conversations. Things
Well,
like you
What
just shared.
are they going to be armed with, Tom?
Excuse me?
What are they going to be armed with? Over 100,000 lines plus of tax.
No. We're not talking about reading the entire tax code. We're just keeping up with general information that they may benefit from in the future.
Okay.
well, what I would say is I would encourage the taxpayer just to make note of certain questions that they have, or if they hear uh, uh, in the news or in a publication of a certain tax change or law that may be coming into play, I would say just keep a list of that, and reach out to me or to another professional, because many times, uh, most of the information is correct, or that they do hear, but some of you don't always get the full picture, and
Right.
so deductions are not tax deductions and credits impact clients differently depending on what their situation is. Whether or not, mostly from how they derive their income. Is it W-2? Is it business income? Do you have dependents? That type of those type of issues. So I would just say, keep abreast of of the news and what's going on, but before you run with a particular tax strategy or conclusion about how you will by a tax law, reach out to me, and especially if I have your history, because if I've prepared your tax return in the past, I have an understanding of how that law could impact you, because I understand your tax history.
Good deal. And finally, on our end, checkoff list. Anything that, as for those who are people, for surely who are entrepreneurs and who benefit more from the tax coding for your services, or even folks who work for a company but may have a side business, maybe doing something to bring in additional income. What are those last few things you need to be checking off of your checklist to make sure that you've got time to get it taken care of for next year's tax season?
Well, just quickly, because I know we're running out of time, but one, and probably should have mentioned this earlier in the call, is for not just business owners, let's say for side individuals, the law who have income from side gigs, starting this year in 2022, if you receive income from one of the payroll, money processors, say PayPal or Venmo, they are required to issue you a 1099 401k if that amount is more than $600. So the issue with that is not all the money that individuals receive through these payment apps is business income. And so anyone who receives money through these apps, it's almost like you're almost defaulted into working with a professional this year, because when you're preparing, when the tax return is prepared, the professional will need to break out the business versus non-business income and make an adjustment on the tax return for that, so the taxpayer doesn't end up paying too much in income tax.
Right.
That's one of the big items that came down the pipe this year. And in terms of other businesses, a business owner, and just individuals as well, the key is to try to take as much money off the tax return, taxable income off the return as possible. So obviously, if you're making contributions to your 401k retirement plan for businesses, SEP IRAs, that's always going to be a benefit to the taxpayer if they can shield income, legally shield income from appearing on the tax return. So any way that you could do that, since close to year end, I would recommend.
So you could have some taxable income via this cash app and don't even realize it, which is another reason to speak to the professional.
And a lot of, sadly, a lot of taxpayers will end up overpaying taxes this year because of that. And what you have to realize is that when you have business income, normally you also have business deductions. So even if it's $1,000 1099 from PayPal, and if you don't list any of your if you have $500 worth of business expenses to go against the $1,000, well, you lose the benefit of those business deductions if you don't understand tax law well enough to know that you can take those deductions.
Yeah, so all the reasons go talk to a professional.
Any help from those folks, John, who suffered those crypto losses this year, or even?
Well, I'm glad you asked.
Yes.
The crypto losses are tax deductible, and so just like if you lost money in the stock market,
Yes.
you can write those off. So yeah, I'm glad you brought that up. Yeah, so if anyone who lost money in crypto, don't forget to give that information to your tax preparer, because it can be used as a business write-off. I'm sorry, as a write-off on your personal tax return.
Any limits on how much they can write off?
No. It's unlike the short-term capital losses. You can only write off $3,000 a year. So let's say if someone lost $10,000 on crypto, they can write off up to $3,000. They can either take that $10,000 and offset other capital gains, or they can take that $10,000 and write it off. But you can only write off $3,000 a year. The other $7,000 would carry to future tax years.
Okay.
The one interesting thing about crypto is not subject to wash sale rules. So if you are
What are wash sale rules?
A wash sale rule, it simply says that if you buy a security, if you sell a security and you take a loss, you have to wait at least 30 days before you can buy that security again. If you buy that security again, it's considered a wash sale, and you cannot write off the loss on your tax return. So one of the good things about crypto is if you're in and out, if you were doing a lot of trading, right now, as the law currently stands, crypto is not subject to wash sale rules. But that's kind of beyond this show. But to answer your question, yes, certainly you can write off the crypto law.
And that means, since that's beyond the scope of this show, John, obviously, as we've run out of time, we're going to have you back in 2023.
Oh, absolutely. It's a pleasure being here.
That being said, let's call a night. And
All right.
Jimmy, we before we call it a night, we would be remiss if we did not wish everybody, including
yes,
John, a very, very Merry Christmas this weekend and a Happy Kwanzaa, because we will be back before New Year. So we want to wish everybody a Merry Christmas and a start of Happy Kwanzaa. And we want to thank everyone for joining us. So if you have folks who would benefit from this information, they did not get a chance or did not know about it, please share this information with them, because, again, we do this to benefit the community. And I know personally that John does not work for free, but we are giving free advice on Black Men Speak to benefit our community. So we thank you so much again.
It's been a pleasure.